Hey everyone, and welcome to this week's video where I'm going to explain to you and really do a bit of a deep dive into interest rates versus inflation and how these two forces can really impact property prices, particularly commercial property prices. Now, I know that interest rates can have a very significant impact on residential property. Sometimes the sensitivity there is quite intense. On the commercial side, when you're obviously buying a property of higher quantum or higher price, 5, 10, 20, sometimes 150 million, and your level of debt is significant. So if you're at a 50, 60, 70% gearing level, well, obviously the cost of your debt, being interest rates, can have a huge impact on your pricing and your ability to enjoy the return from that asset. So I'd like to jump into both of those things, those two competing forces, and see how they actually compete to impact property prices. So without any further delay, let's get into it. So what I'm going to cover. So the first thing is I'm going to take a bit of a dive into what interest rates can do to prices. Okay, so it's really important to understand that impact. Interest rates are there as a mechanism to curb inflation, to keep monetary policy, to keep the economy in the right state, growing at the right rate. It can have a devastating, but also a fantastic impact on commercial property. So I'll cover that off. Second thing I'll cover is the impact that inflation has on prices, or what I should say is the impact that inflation could have on prices as a secondary effect, but what the impact of inflation could be on rents, which is the primary effect. So I'd like to cover both of those. And then obviously what happens when they compete. So I actually use one or two different assumptions and a bit of a case study for you to actually see what is the resulting impact from a rise in interest rates and a rise in inflation. What will happen? What happens if interest rates come back? Well, what will that mean? What happens if inflation comes back? What does that mean? So yeah, bit of a model that we can kind of play with, which is fantastic. So before I get there, guys, why listen to me? I've got over 20 years of commercial property investing experience. I've been doing this for over 2 decades. I've got well over $500 million of property transacted personally. So the things that I'm covering in these sessions are tried and tested. This is not my first rodeo here. I've been very lucky to transact some of the on some of the most aggressive, some of the softest, the most aggressive, some of the best, some of the worst property in Australia. So I'm very, very lucky to have transacted on those. I've done well over 100 leasing deals, leasing tenants from IGA to Dan Murphy's to Total Tools to Freedom Furniture to Centrelink to Caterpillar to all the office users you can imagine, childcare centres, petrol stations, you name it. I've done a leasing deal there. So I come with a lot of experience about how to actually create value through leasing. My syndicated business produces an average return of over 21% per annum on average since our inception, which we're very, very proud about. Now that is properties that we've bought, managed and sold on behalf of our investors. That's the investor return. And I've now got countless examples of generating a far better return than that actually on private clients and personally in my own portfolio. So some of the examples there are 100% plus. Some of them are well into the 300% plus per year, which is pretty astronomical actually. But if you use the formula that I show you in my online course, then this can become a reality for you. So having said that, if you like this content, please subscribe, please follow, please comment. I really want to understand how to best serve my audience. So please interact with me and I look very much forward to you following in due time. Okay, let's get into the feasibility. So I'm actually going to take you across to the feasibility now and show you these dynamics. All right, so I think just to set out what I want to cover here, it's important to just go through a few assumptions. Now, what we're doing here is we're using an assumption. I want you to focus on the left-hand side here of the screen, the purchase and due diligence costs. So what we're doing is we're assuming a very simple commercial property acquisition that is very vanilla in nature. So a $4 million purchase price, we're just assuming that. And then we've got the costs involved to acquire that property. Okay, you've got stamp duty, call it 5%. Again, we're just being very, very broad brushstroke with our assumptions. This might be 4.65%, but let's just say it's 5%. We've got a property valuation, legal contract and lease review, a settlement cost, technical due diligence to tell us what's going on with the four walls, the ceiling, the air cons, the bitumen, the doors, the roller doors, everything in the property. An aircon report, potentially, an area survey to understand the net lettable area of the premises in question. Now, some people are using a buyer's agency to buy their property. I'm obviously not. But if you were using a buyer's agency, they're typically about 1.5% to 2% in terms of commission. A demographics report potentially, and maybe just a bit of a bucket here for other costs that could come up, all right? So we're at $286,000 of cost, which is about a 7% cost base on our purchase price, all right? So I ran through that pretty quickly, but all I wanted to do is get to the place where we can actually use, I'm not going to say a real life example, but a very, very a likely scenario here of a $4 million purchase price, $286,000 worth of costs, okay? And then I'm going to show you how I've calculated this number, but an equity invested here, I'll make this yellow, of 2.286 million, okay? So those are some assumptions on the way in. The other assumptions we've got here, and I'm going to show you how these forces compete for property prices, but the other assumptions we've got here is inflation. So what is the inflation rate? What is the variable interest rate? Okay, as in what is the cash rate? Okay, now the cash rate is different from the 30-day rate, the 90-day rate, the 180-day rate, the 3-year, 4-year, 5-year, 10-year fixed rate, and I'll explain that to you now. So I've given the differential here between the actual cash rate and the 5-year rate, and then a presumed level of debt. So if we're going to acquire a commercial property for $4 million, we might be looking at getting, a 50% level of gearing, which is about a $2 million debt level. And that number is used to calculate how much equity we have invested. So if you can see here, I'll show you this sum is literally a $4 million purchase price. We have to add on our costs because there's about $286,000 worth of costs. Then we've got to take off our debt because the bank's going to put that money in, which will then show us the resulting amount of equity, cash, that we have to find to purchase the property. Okay, it's 2.2867. Now, as a very quick example here, if we change this debt level to 60%, you can see that equity invested came down by almost $1 million. Okay, 1.886. Okay, so anyway, these assumptions here we can play with, and we can see how they impact things as we go. But what I want to show you now is this table. Now it's a bit small, so I'm actually going to make it a bit bigger, and then I'm going to delete it. I'm going to make it smaller again. This is a screenshot of an email that I get from various banks because I've got quite a lot of debt with the banks. I get a screenshot like this every week, and some weeks are more important than others. Obviously, we've very recently had an interest rate movement at the start of May 2026. So this particular screenshot showed what the rates were looking like in early April, so the 8th of April 2026, versus when the screenshot was taken on Monday, the 11th of May 2026. And then what it does is it shows you the percentage change in terms of basis points. And then it also shows you the percentage change in terms of how much this basis point change reflects as a percentage of the original base amount. Okay, so what we're essentially, if we just take the top line here, we're going, okay, the RBA cash rate was at 4.1% in April. It moved to 4.35 when the RBA met earlier in May to increase that rate. It increased by 0.25%, which is 25 basis points. And that reflected a 6.1% increase in the cash rate. Okay, so this final column here is showing that percentage increase, and typically it's a percentage improvement or increase in the rate. It could be a percentage decrease, but in this case it's a percentage increase. Come back to why that is so important In fact, I might just cover it now. The reason why that is so important is because I want you to understand the difference between the sensitivity here of the RBA cash rate, the 30 and 90-day rate, and then the difference there between the 5 and the 7-year rate. Now, the 30-day BBSY has a similar sensitive adjustment to movements in the cash rate. So what am I saying there? I'm saying that 6.1% increase in the cash rate and a 5.6% increase in the 30-day BBSY are rather similar results. The question then is, well, why is the 90-day BBSY at 2.57? Why has that only moved 2.57% upwards when the 30-day and the RBA cash rate moved, 5 and 6%, 3 times more? And the reason is that the 90-day rate is essentially the expected interest rate movement over the next 90 days and then present valued to today. So it's already saying that because there was an expectation that interest rates were going to increase, the 90-day rate had already factored that increase in to some extent, not to the full extent, but to some extent had factored in a very likely increase in the cash rate during the next 90 days, which means because of that, there was a less sensitive movement to the cash rate actually moving at the start of May because it had already been factored in, okay? And that is even more pronounced when we start looking at 5, 6, and 7-year rates, because a 5, 6, and 7-year rate is essentially 5 years of projected interest rate movements up and down, and then present valued to today. So it's literally going, okay, well, over the next 12 months times by 5 years, these are the amount of movements up and down in the interest rate that we expect from all of our forecasts and economic data. And that's what banks do. They'll actually forecast that for 5, 6, 7, 8, 10, 15 years if you want. Then they'll bring that back to a present value, and that is essentially what you are able to see here. So it's a far less sensitive movement because there's been such a expectation of rates increasing anyway this year, all right? So you can see here the 7-year rate went from 4.99 to 5.08, which is a 1.8% increase in that base, okay? Now, what is really interesting is that those numbers, that kind of 5, 6, 7, 10 years, those numbers moved drastically right at the start of 2020 when the interest rate environment had its first increase in this first increase in the cash rate. So as you might remember back then, the interest rate was almost flat for months and months and months and months and months and months and months. All of a sudden, bang, the RBA came out and said, hey, we've hiked the rate by 25 bips. And immediately there was obviously a change to the RBA cash rate and the 30-day rate. But the 5, 6, 7, and 10-year rate moved astronomically because they said, oh my gosh, this is the start of a monetary policy where we're going to see interest rates rise and rise and rise to curb inflation. So all of a sudden, the long-term yield rate kicked out drastically. But since then, there's been a lot of those expected rates have now happened. So now there's only obviously a few moving parts over the next 5, 6, or 7 years, as you can see here, where there's an expectation that rates over that period, look, if we're at 4.35% today on the cash rate, essentially what the 5-year rate is saying is that there is expected to be some more interest rate movements upwards and a stabilization at about 5% on average over the next 5 years. So I've taken some time to explain that, but it's really important. And the reason is people that are buying commercial property who have the benefit of a lease in place have the chance to leverage that property, so secure debt at typically 75% to 80% of the length of that lease. So if you've got a 5-year lease in place, what I'm saying here is that the bank, if your financing partner, will often allow you to leverage up to 4 years of fixed interest. So they'll give you a 5-year term and they'll allow you to fix 4 years of that, which is about 80% of your lease term. They won't let you usually go over the lease term because that means they would be giving you debt beyond your known income. Obviously, your lease term is a known income. When that dries up, or the bank doesn't want you having debt beyond that. So the bank will often say, look, we'll let you borrow money to 75 or 80% of the length of the lease, and will allow you to fix that debt, which means that commercial property purchasers, if they're sophisticated or slightly sophisticated, they have the benefit of enjoying 3, 4, 5, 1 or 2, sometimes 7 or 10-year fixed rates. Now, we've recently bought a property in 2022 and we had a 10-year lease in place and we took a 7-year fix at 4.29. So you can see now that fix is already in the money. It's more competitive than a 7-year fix today at 4.99, right? So obviously if we had to sell the remaining value of that fix to the market, we would get paid money. As in, instead of incurring a break cost, the bank would actually pay us to enjoy the benefit of that fix. So the reason why that is important is because residential prices tend to be far more sensitive to the RBA cash rate and the 30-day rate, because that's typically the way that residential interest rates are levied on residential property. Unless the bank has allowed the borrower to fix their debt for 3, 4, 5 years, which is made up by the bank's own reasoning. So the bank is actually determining that 5-year fix or the 4-year fix, whereas what you're seeing here is actually the money market determining this amount of money, not the bank. Okay, the bank is your conduit to actually secure this debt directly with the money market. So the difference there is that residential property can be very sensitive to movements in the cash rate, whereas commercial property that has a 5-year lease in place should be less sensitive in this particular dynamic because of the fact that there might be a 5-year lease in place, which means that you can take a 5-year fix or a 4-year fix. And as you can see, the 4-year money barely moved. So sometimes you'll get buyers saying, oh, I can't buy that property at $10 million anymore. I need to buy it now at $9 million because the interest rates moved. But a good agent will say, well, hold on, there's a 7-year lease in place. You were always going to borrow money for 5 years, and that's barely moved at all. If you weren't taking into account 0.11% change in your interest rate, well, you shouldn't be buying this property anyway. So there's a level of sophistication that it almost saves the commercial property market a little bit from an oversensitivity to interest rates. Now, there's obviously circumstances where that's very different, but right now in this market, now in May 2026, there should be less sensitivity if you're borrowing money for 3, 4, 5 years than if you're relying on the cash rate. All right, let's make this smaller again. Now I want to get into this model and show you exactly the impact here. Now remember, there's two competing forces, and typically speaking, the RBA wants to use interest rates as a mechanism or a monetary policy to curb inflation. Now we know right now, I'll show you a snippet here. We know right now, this is a screenshot that came with this email from National Australia Bank, right? It's interesting to note here that it says inflation. Trimmed mean inflation forecast was revised higher to 3.5%, while headline CPI is predicted to remain elevated at 4% by the end of 2026. Okay, so obviously that is above the 2% bandwidth that the Australian government has always tried to manage. So it's likely then that there may be another increase in interest rates to curb inflation. So what we're going to see here is how inflation can play out on the growth of rents over time. This is really important, and it's probably the biggest assumption which underpins these models that I'm going to show you. The biggest assumption here is you have a rental lease in place with a rent that is stipulated to escalate with inflation. So it's indexed to inflation. Okay, as in the lease, it'll actually say this rent escalates by CPI data of Western Australia or CPI data of Victoria over the past quarter or over the past year. So that means that the rent will review annually upwards by CPI. Now, there are obviously leases in place where the tenant and the landlord have agreed a fixed escalation of maybe 3% or 2% or 2.5%. But for premises that are enjoying a lease with the rental that is indexed to inflation, obviously the higher the inflation is, the greater rental growth you're going to experience, which is a fantastically accretive exercise, value accretive exercise for property. Okay, not only does your cash flow go up, but the value of your property can go up, and I'll show you how that works. Naturally, the opposing force there is interest rates. Okay, so what I want to show you is exactly how this plays out. So what I'm going to do here is these numbers on the left here, inflation, variable, 5-year, and debt to a lesser extent, but let's look at these three. I'm going to show you this table at the top is exactly the same as this table at the bottom, okay? And these are the inputs that we're going to change only. And I want to show you the difference, okay? So right now, inflation was expected to be 3.5%. This is prior to May, to the May rate rise, okay? So it was expected to be 3.5%. The variable cash rate was 4.1, as we can see from this table up here that I screenshotted. And the 5-year rate was 4.9. Okay, cool. So what I want to show you down here is what happens if inflation goes to 4, the variable goes to 4.35, and the 5-year fixed goes to 5.01. Again, all from the screenshot here, okay? This is what I want you to note. A $4 million purchase price or $4 million value. Now, the big assumption here, on top of, there was two major assumptions. The one major assumption was rent is indexed to inflation. The second big assumption is that the cap rate stays the same. This is really important to note, okay? The cap rate stays the same. Now, cap rate is essentially I suppose a numeric to, it's really a numeric to show the dynamic of demand and supply in a market, but it shows you the capitalization of rent. So in this case, if you're receiving $260,000 of rent per year at a 6.5% cap rate, that drives a $4 million value. So I think that's a very fair and reasonable assumption here, and we'll carry that assumption through the rest of these years, okay? 6.5% cap rate stays as it is. If you've got rent at 260 grand and you've got an escalation at 3.5%, again, which is directly from this table, in year one, at the end of year one, so 12 months down the track, your rent would have gone from 260 to 269,000. Now, if you use the same cap rate, you have just capitalized a higher rental amount, which means that your value is now higher too. If the higher rental is capitalized at the same cap rate, well, that produces a value of 4.14. And you can see if we do this again, we escalate the rent again by CPI. Now we're at $278,000 a year in rent. We capitalize that at 6.5%, we're at 4.28. You can see that if you do it again, we're at 4.4, we do it again, we're at 298,000, which is a $4.59 million purchase price or valuation at the same cap rate. Then what I want to show you is what that does in terms of difference in price or difference in value. So here we can see there's been 140 grand improvement in the price, okay, based on the same cap rate, based on a 3.5% escalation in the rent. So not only as a property owner are you getting more rent next year, 269,000 versus 260, so you get $9,000 more in rent. But if the cap rate stays the same, you just enjoyed $140,000 improvement in the value of your property. And that is how you make money in property, guys. Dun-dun-dun-dun. Drum roll. So what I want to show you now is the next step. Okay, well, now we can see there's been a $284,000 increase in price since our base year. Over here, $434,000 increase in price since our base year. So you can see we can extrapolate pretty easily. The other thing I want to show you here is an assumed interest expense. Now that is a very quick calculation of a $2 million debt level times by the interest rate of 4.1, and that gives us an interest expense. Now that 4.1 comes straight from here, which is the variable cash rate, okay? So the actual cash rate. Now this is, remember, this is what it was in April, and then this is what it was in May. So stick with me on April here. What this is showing is a $269,000 increased or escalated rent at the end of year one, and you've now enjoyed, had to expense $82,000 in interest. That leaves you with a cash flow of $187,000. So that is showing a return, as in an actual net receivable in your pocket, of 8.18% on your invested equity of 2.286 million. So very quick sums again. We've got rent coming in the door. It escalates every year. We've got interest expense going out, which does not escalate every year if you fix. If you don't fix, it does. Because what I would have to put in here, let's just say that the entire of next year was at 4.35%, then obviously your interest expense goes up, okay? But let's presume that we can fix our interest now for 5 years. So let's then move this number. I want to go Control Z. Now I want to move this number to 4.9, which shows you the 5-year fixed rate. Now we're fixing our rate here, which is removing a variable, which is great, okay? So interest rate goes up. Yes, it does go up to $98,000 a year, our interest expense, which produces a slightly lower cash flow or net cash flow and a slightly lower equity return, but it's fixed. It doesn't move for 5 years. And look what that does over time. We've got this gorgeous improvement in the equity return, okay? So this is all as at, let's say this is all as at April 2026, before the most recent RBA announcement at the start of May 2026. Now I want to show you May 2026, okay? And again, exactly the same set of assumptions, $4 million purchase price, 6.5% cap rate, escalation at 4% now, because that is what the headline inflation is. Headline inflation is predicted to remain elevated at 4%. Now the cash rate has gone from 4.1 to 4.35, but interestingly, the 5-year rate has only gone from 4.9 to 5.01, and I want to show you that now. So let's take the escalation, you can see is 4, okay, very solid. Now I want to show you the interest rate. Instead of it being the variable rate, we're already assuming it's the 5-year fix of 5.01. And look what is happening here. We've got a $4 million price, $260,000 coming in the door. Obviously, we've got $270,000 of rent coming in after the first year. So the first year is $260,000, the second year is $270,000, third year's, third year, it's the second year of full ownership, $281,000, and you can see it escalates over time. Now interest rate's fixed here because we're fixing for 5 years. Our interest, which means our interest expense is fixed, which means our net cash flow is essentially just a function of the increase in rent by 4% escalation, which is a CPI-indexed escalation, produces a cash flow here. Now this is the part I want you to note, is that it started a little bit lower, 7.44 versus 7.48, because obviously that slight movement in the 5-year money of 4.9% versus a 5.01 means that there's slightly higher interest here, okay? But look what it does over the long term. 7.92 is better than 7.89. Now you've fixed your interest rates, remember? So now the only thing left for you to do is enjoy a higher escalation. 8.4% rather than 8.32, 8.92% rather than 8.71, and 9.45 rather than 9.2. And what I want to show you here is the average of these years, 8.43 versus 8.34. Now that's not drastically different, but it shows you exactly why a movement in the cash rate may not actually be a bad thing for commercial property if your rent is indexed to inflation and if the cap rate stays the same. 2 major assumptions. I want to show you something else here. If your level of debt was 60% and 60%, can you see how this gets more pronounced? So now the difference is 9.15 versus 9.06. okay, because you've got a higher debt level. So obviously there's a slightly greater interest expense, but there's also a slightly greater margin on the bank's money. So your debt level is also very important in commercial property. Now, residential property where you're leveraging at 80, 90, sometimes 100% is extremely sensitive to interest rate movements. I'm suggesting that commercial property is slightly less sensitive to interest rate movements given the right environment, okay? Now, if we rewind our minds back to 2021, when interest rates just started to move, it did a drastic impact on cap rates because cap rates went from like 4.5, they blew out to like 6.5, okay? So that's a massive hit to capital values, okay? But in the more recent times, like the last 4 to 6 months have been more stable in a cap rate environment because there's been more stability in the interest rates. Yes, there's been a movement, as you can see, in the 5-year rate from the increase in the cash rate. But the interesting part to note is that I believe commercial property prices are less sensitive at this stage of the cycle. Now, if interest rates continue to move, it's definitely going to have a continually increasing impact on commercial property prices, because obviously the delta between your cap rate and your interest rate is the margin you can make on the bank's money. And as that interest rate increases, there's a lower margin to make. The caveat there is that if you're able to fix your interest rate for 3, 4, 5 years, I would be more concerned about this movement than necessarily this movement to the cash rate. So as you can see here, the 5-year money is already factoring in another almost from 4.35, another 65 basis points worth of interest rate increases over the next 5 years. So, you know, if interest rates do move next month in June, I wouldn't expect the 5-year rate to move drastically because it's already factoring in interest rate movements. If there was a 50 basis point increase in the cash rate in June rather than a 25 basis point cash rate movement, that might be more concerning because it might show us that the inflationary target's getting out of hand and there's going to be more interest rate movements than actually expected over the 5 years. So it's really interesting to see how these numbers are impacted. You can almost plug these numbers in daily to see the impact of property prices. So a lot of assumptions underpinning this, but I really wanted to cover this because a lot of people immediately think, oh my gosh, interest rates have moved, commercial property prices are going to get smashed. And I disagree. If there's a couple of assumptions in place, if you're able to fix money for the longer term, so 3, 4, 5 years, which is less sensitive to movements in the cash rate, if you have a rent that is indexed to CPI or inflation. Now, if you don't, naturally, you're not getting the benefit of higher inflation, but you're getting the stability of a fixed cap rate, okay? And the third thing is that the cap rate stays the same. Now, ultimately, over time, if we keep seeing interest rates move up and up and up, well, the cap rate will naturally start to reflect slightly higher. So that's an assumption that needs to be battle tested as we continue to move through the economic cycles of this year. Okay, so we've covered a lot of information there. What I want to do is go back to our PowerPoint now and just really sum up. So what did I cover? On interest rates, I covered the impact to the cost of debt, all right? Now, there was some flow-on effects to the cost of debt there. Really what we wanted to look at was the delta between the property return, or the cap rate, 6.5%, and interest costs at, call it 4.35. But what was more interesting was that the variable rate at 4.35, or that movement from 4.1 to 4.35, versus the long-term rates, which only went from 4.9 to 5.01. So what we're showing you there is the sensitivity of the variable rate was far higher than the sensitivity of the long-term rate, okay? The other thing we covered was inflation. And if your rent is indexed to inflation, well, obviously there's a natural upwards pressure on your rental. There's a flow-on effect from that, which I would like to cover. We do know that rents are capitalized into value, so higher rents can mean a higher capitalized value. But here's what I wanted to be careful of. You need to make sure even though inflation might rise and you might get more rent next year, we still want to make sure that the passing rent that you're going to receive is related to or still relevant to market rents. If you're getting $100 a square meter in rent and inflation jumps to 10%, and all of a sudden next year you're getting 110, and next year you're getting 121, and next year you're getting 132, and the market rent's staying at 100, well, all of a sudden your cash flow is getting better, but your property value may not be increasing as quickly because the market rent is what's usually capitalized into perpetuity. So typically speaking, market rents catch up with CPI over time because CPI is an inflationary, as a basket of inflation across all goods, including, bread and milk and cheese, but also property prices. So the thing that can hold market rents more stable is the demand and supply of available space in that area, okay? So the distinction here is that not only are you concerned with the improvement in your rental that you're gonna receive, so your passing rent, which is great for cash flow and great for property value, but it can start getting disconnected with property value if the market rent is also not shifting upwards over time. So it's really careful that it's really important you understand that. The other thing that's important to note with inflation is that it can cause upwards pressure on rents, which is great. But sometimes when it comes to negotiating your next lease, or when you're stepping into negotiations with a tenant, you may not be able to secure an inflationary index if the tenant's seeing inflation jump really, really high. Then the tenants are usually going to want to say, hey, rather than inflation, I'd like to index my rent at 3% fixed. So it can mean that there are more robust tenant conversations because of inflationary pressures. Because tenants are, they've got costs at every cycle. They've got costs of obviously rent, but they've obviously got cost of maintenance, cost of their goods, cost of shipping, cost of, cost of employment or whatever it might be. And then obviously the cost of selling their good. And if they can't increase the price of selling their good because it's more sensitive to inflationary pressures, well, they're going to want to try and save money elsewhere. So I also covered what happens when they compete, what happens when inflation and interest rates compete, and whether there will be a rise or a fall of asset value is actually largely driven by asset specifics. And that's what I mean when I say that the cap rate is so important. If the cap rate starts to move, well, naturally property prices are going to be very sensitive to that. But if you're looking at long-term interest rates, 4 or 5 year fixes based on 7 or 8 year lease terms, then they are less sensitive to movements in interest rates in today's environment, which means there is a greater propensity for cap rates to stay the same for leased assets. You can imagine though, if you've got a vacant asset or you've got an asset with a lease term of only 18 months and you can't fix with the bank for 4 or 5 years, well then your property is naturally going to be price and rent now more sensitive to the variable interest rate than it would be to the long-term rate. So again, what I'm saying here is that the assumptions we looked at in the Excel modeling are great, but it still comes down to asset specifics and your lease term and the index of your rent to inflation or other measures. So with that all being said, thank you so much for listening here. I cover all of these things in my online course where I focus on 3 key actions that drive enormous value in commercial property. We covered one of those today being rent, market rents versus passing rents, and how to use that delta to your benefit. I teach you these essential things, exactly what you need to know, what to do, and how to secure opportunities that allow you to create life-changing money in commercial property. I cover it all in my online course. So please, if you'd like, go find it on my website, investorcode.com.au. And as always, guys, if you enjoyed listening to this, please subscribe and follow, and I'll see you here next week. Thanks so much for your time.